talking to Cesar Jimenez from Bayfirst for a reason. They're a top 5 SBA lender. SBA is the Small Business Administration. And so again, if you're selling industrial, medical office, hospitality, we're going to have an opportunity. And we have a couple dozen banks that are constantly calling me looking for SBA deals. But Cesar and I sat and had coffee and became Menschkeit, got together and said, this is how we work. And I'm grateful because he's here in Tampa and he's going to spend a half hour or so talking to you guys about SBA lending. Welcome, Cesar.
Thank you. Woo! I got to say, this is very cool. I expected to get in a room with a bunch of guys like our age and just shoot whatever.
This is the future, right?
But this is the future. I see young entrepreneurs, executives. I mean, I'm getting goosebumps just thinking about it because there's so much you guys are about to embark upon that it's really exciting. A little bit about me. Number one, I had the pleasure of meeting Brian because we did something old school that perhaps you guys aren't used to doing. We actually hooked up on LinkedIn and we met in person at a Starbucks. Okay, so, and we got along. We hit it right off. It was great. But that old school stuff, it still works. Looking in the eye, shaking a hand, and getting to know one another, it works. Okay, so let's talk a little bit about me, and then I'll branch off into the bank and what I do. I'm originally from Jersey, and that's how Brian and I got. Are we on?
Yep, you're good.
Okay. I'm originally from New Jersey. I went to Seton Hall University. I have a major in accounting. And in a prior life, I did the debits and the credits. I did the financial statements. I worked in both public and private. I worked for one of the largest single office CPA firm in Jersey. And I worked for the 5th largest public relations firm in the world in New York. And that was a lot of fun. It was good. I learned how to be an accountant. I learned my debits and credits and financial statements and all that good stuff. Then I came to Florida because I was sick and tired of the snow. I had it. Started doing a bunch of different things. It's not important. I was a controller of a company. And then I got into a situation where the company I was working with needed funding. So we really didn't know what to do. So the CPA guy came on board and he kind of walked us through what we needed to do. Long story short, I did all the work. I did all the financials. I put the package together. I did a narrative. I did an overview of the company and the owners and what we do. And it went off to Merrill Lynch. Merrill Lynch was huge back then. And we got like, this was like in 1998, 99. We got a $500,000 line of credit for the company. So the CPA came to see me later. He said, Cesar, whenever you get sick and tired of doing this, give me a call because you were born to be a loan guy. You're bilingual, you're an accountant, you're charismatic, you're this, you're that. Like my head's getting big.
Caesar speaks, right? You speak Russian, right?
Oh, no, not Russian. Not yet. But
no, so I had a client that we decided wasn't going to be a client when they were in South Florida. And one of a broker, an independent broker down there that I work with, said, we're doing this SBA loan. She doesn't speak any English. So I had Cesar underwrite the deal. He says, yeah, we'll make a loan on it. I said, so it's going to be a little challenging. And he goes, great news. I speak Spanish.
That's right.
So
that's right. That's right. So, and listen, FYI, a little reason, I'm just going through this background because you guys are so young. And again, I'm excited seeing your faces because you're about to embark upon a whole new future. And the point I want to bring out to you is that in the beginning, you're gonna find yourself. You're going to do this. You're going to do that. You're going to make mistakes. Who's going to get fired? Whatever. It happens. But don't worry about it. The important thing is that take the experience in and learn as much as you possibly can. And what I did is along the way is I guess I finally got to a point where someone saw something in me and they said, you would be great for this. And I bit. 2-3 months later, I said, hey, Alan, let's go. Let's do this. I'm ready. And that was like in 2000. I've been lending ever since. I have lent hundreds of millions of dollars. I've made a lot of money, had a lot of deals turned down. If you can't take the word no, this is the wrong business for you. Okay? So you got to keep pounding and you got to keep moving forward. So fast forward, because of changes in the economy, I went from just being a residential, commercial SBA lender after the crisis to being more focused on SBA, because when things get tough, conventional lenders begin to tighten up the screws a little bit, and the SBA says, "Come on down. We want to do the loan." So, long story short, I had like a $10 million commercial real estate pipeline back in 15, and a SBA bank up from Boston came down to visit. And we went through the pipeline. We went to do site visits, which is traditional in what we do. And the president and operating officer of the bank said, "Hey, we don't have representation in Florida. What are you doing?" Long story short, they fly me up to Boston. I interview with a bunch of people. And on the way home, there's already an offer in the inbox for my to go on to the banker side from the broker side. And it was a good move to make at that time. So now I started working on the side of the bank and really getting to learn the ropes in the SBA environment. So I've been with a few different banks, and I'm really excited to be here today because I've been fortunate enough. And again, this goes back to working, learning, networking, getting relationships, having a good name, having a good reputation. So when you go back to people that you've met in the past, they say, "Hey, yeah, I remember you. You're a good guy. You're a good girl." So whatever the case may be, I met people in my past, and now in the fast forward, they're like, "Yeah, let's go. Let's do this." So here I am. I get an offer from Bay First. I'm here talking to you guys. We are the third largest by volume lender in the country. We are the sixth largest lender by loan amount in the country. We do more SBA loans than Bank of America. We do more SBA loans than Chase. We do more SBA loans than, I believe, even Wells Fargo. So we do a lot of loans.
And where are you headquartered?
Right here.
Right in Clearwater. These guys are local.
We're right here. So have many of you had any exposure to SBA lending, 7As? Is this all Chinese to you guys?
This is right now. Yeah, you got to start. You're starting with basics.
So let's start with some of the basics. What makes the SBA so special, which started by President Eisenhower back in, I believe, 1954, is that it encourages or induces banks to make loans that otherwise conventional lenders would not make. Let's do a quick example. I just issued a term sheet for $420,000 acquisition of I did the Lash Lounge and I did the other one. Oh, okay, an air conditioning company. It's a home-based business. There's no commercial real estate. There's some working capital that we're going to need. There's franchise fees involved in that. And there's some trucks. I think the biggest thing we need to hear that I just said here is that it's a home-based business. So what's that mean? So that means that there's no office that he goes to on a daily basis, and there's probably no office that he's going to purchase that we could, as a lender, use as commercial real estate collateral. A typical bank like Bank of America or Chase, Wells Fargo, any of those guys are not going to really want to do that deal because they want collateral. Their lending regulations, for the most part, induce them or encourage them to make loans that are based on collateralization. On the SBA side, we can do things a little differently because if we make a loan for different types of loans, the government guarantees a certain percentage of that loan, anywhere from 75% up to 90%. So, quick example, we make $1 million loan, we do everything right. 3 years into the deal, for whatever reason, the company goes belly up. Let's say they still owe us $1 million for the sake of conversation. We are guaranteed to get $750,000 repaid to us for that debt from the government. So that really changes the complexion of a regular Joe being able to get a loan. Okay. So long story short is let's open this up here.
So it's not just for non-real estate. So for those of you who are, so for the retail people are going to do with retail, you're going to be dealing with non-owner occupied. But any of you who are going to deal with owner occupied real estate, they can also do tenant improvements.
That's right.
And so we'll talk. So this is why SBA is in the bailiwick. And again, you're going to come to me when this happens. But they also make real estate based loans, car washes, I showed the Saint Hotel over to Caesar
Yeah.
and said, we're going to try to find a way to find a buyer for this. And he looked at it and said, we love this property. Like, we'll make a loan on this. Yeah.
Is that the St. Pete one?
Yeah. The one
Okay.
we're talking about.
And for the
So-
record, we discussed it with the president of the bank.
Yeah.
He wants it.
Yeah. So, I mean, president of the bank in Clearwater, right?
That's cool.
All we got to do is find a buyer. And we have financing already. And we can help this listing agent who's not a Matthews out. And you guys can earn some money on that. Like, a buyer's agent can earn money.
I just put all the information in that
You did.
outlets too,
That's
like
awesome.
the contact information for the listing agent. So
And he's touching on a whole, so many different things that are just awesome. What I want to push out there is I want to push a phrase down to you, and don't forget this. Try not to forget this. Getting all the juice out of the orange. Okay, this isn't just about having your client purchase a piece of commercial real estate from you and having it get funded, having it get a loan, etc. It's perhaps helping that same commercial real estate guy that's buying that building fund his existing his business that's going into that building. So maybe he needs $2 million to purchase the real estate, right? He might also need another $500,000 in cash and working capital to hire people, to push a new marketing program, to buy a whole bunch of new CPUs and laptops for a pit just like this. Those are things where we can come in and help you structure a deal where he gets the building and he gets the working capital that he needs. Now let's talk about the building. Typically on a $2 million deal, anybody know what a conventional bank is going to want you to put down?
25%,
40.
or 20%.
Depending upon
What was
today's
it?
market, 35
Yeah.
to 40.
Correct. Anywhere from 20, 25, 30, 40% based upon the relative conditions of the situation. If you come to me, I could potentially do that deal 100% financing, 10% financing, 10% financing with seller contributions, 10% contribution with seller held note, additional working capital put into the deal for leasehold improvements and build out. There's just so many things that we can do that at the end of the day is going to get your client into that building and get you to be able to get a loan and create more income, because yes, most SBA lenders do pay a fee to referring agents for bringing the loans to us. Okay, so you can make a few dollars here. Okay, so that's one scenario. But let's start smaller. On the small scale, we have loans, unsecured loans that it's almost like getting a quick revolving line of credit that's up to $150,000. We call it the bulk program. We closed about $25 million of this product just last month. So just think of $150,000 a pop. That's a lot of loans.
Yeah, anybody here thinking of doing leasing? Okay, so if you're doing a retail leasing, this is going to be a really interesting thing. You're going to be able to come to me and say, I'm going to make this up, okay? Someone who's a reseller of Vineyard Vines is going into this building we're leasing in Hyde Park. But, the TIs, the landlord doesn't want to do the TIs. It's going to be $80,000 to build the place out. I'm just going to make one call. And 2 days later, we're going to have the funds for them. And now your deal comes together.
So this is one aspect. There's quick loans that we can do unsecured for up to $150,000. This, if you have a 700 credit score, 2 years in business, tax returns, submit them. This can be closed and funded within probably about 7 business days. Then there's another one that's very similar that we call the flash cap. That's up to $350,000. It's kind of the same. You get more money. The credit score is a little bit lower. I think the threshold will go down as low as 650. And again, no collateral. Okay. And now there's a lot of SOP changes that we're going through right now. So a lot of the guys on my side of the fence are reading new pronouncements every day. I was just going through a Nagel bullet point list this morning, just trying to keep up with all the changes. And there's a lot of changes. What we have to go by is what's called the SOPs, the standard operating procedures that are put out by the government. That's our Bible. So if we want to make an SBA loan, we have to make sure that we abide by these particular rules that we're given. But the rules have just been made more beneficial for the borrower. Bottom line, that's the end of the story. Okay, it's more beneficial. It's easier to make some loans. Going forward, we can also do what we call, which is our bread and butter. We call the core SBA loans, which is a 7A loan. The 7A loan is a program that really helps the small business owner, and it really encourages us to be able to get aggressive and make things happen that a conventional lender just can't make happen. And every blue moon, you'll hear a story that, oh, my bank did that. The guy's probably got a net worth that's ridiculous, has scores that are ridiculous, and he walks on the water. So that's a type of scenario where you'll get a conventional lender doing something outside of that box. As far as other things go, SBA, let me give you an example. I had a printing company that was around for like 25 years. Mom and dad ran it. They owned commercial real estate. They owned tons of heavy equipment, $1 million worth of equipment. And the son owned a small portion of the business as well. I believe he owned 15 or 18%. Mom and dad are ready to move on. They want to sell their business. The perfect person to sell it to is their son. Most people would think that that's probably not an arm's length transaction. It's like, sounds fishy, mom and dad selling to their son. What's going on here? But we were able to take the company, put together a presentation, submit it for review, to go to Sacramento because it's a special loan. It's a business succession deal. And again, we have mom and dad and a son, so it's got to be looked at very carefully. Long story short, mom and dad sold the business to the son for $4.2 million. We got them the loan to take out existing debt of approximately $2.8 million. We got them another $1 million for commercial real estate. And then the balance, which was approximately $1.2 million in cash, was wired to mom and dad's account that day after selling their business. So that's pretty huge, guys. Just think about it. Mom and dad now have their retirement in cash in the bank. The son was able to acquire the business from mom and dad. It's all his. And every single person that works for that company still has a job. And every single person that's related to that employee in the family, their life is staying cool. This is what I want to impress upon you all. What we do touches so many people. And I don't want to get corny, I get goosebumps saying it because I enjoy being able to do something like this to help people. You really have no idea how many lives you're touching when you make these transactions happen. It's not just about getting that, oh, I closed that $2 million deal. I closed that $5 million deal. I did that. It's what's behind that deal that just creates so much goodwill. It just makes things good. Okay. It's a great feeling. So that's one example. Let's talk on a smaller scale. You have people that are a nurse or a plumber, and they're married, and they're looking for something else to do. They go to a franchise show that's at the Emily Arena or in Fort Lauderdale, and they go to a kiosk and they realize that, wow, this is what we want to do. They want to open up that Little Caesars Pizzeria. Okay, I just issued a term sheet for that yesterday. They want to issue a Little Caesars Pizzeria. They have some money. They're going to put it in. $400,000 loan, no collateral. Again, no collateral, $400,000, 10-year term. Right now, interest rates are a little high. It would be Wall Street Journal Prime plus 275. So effectively today, that rate would be 11%. Now, we know that 11% is a term that we usually use hard equity, which is expensive, but that's where we are right now. And I do feel that in the coming years, the rates are going to start getting a little bit better. So that's another situation where you have a client that now has purchased a franchise. Now, this might be a good client for you to help that they have their franchise in. Again,
So I want to put this out because I did something like this just back in February. I had a transaction, and this is I want for those of you that are going to be listing and selling properties, which is most of you. You may list vacant properties. This was a vacant car dealership in Fort Lauderdale. The buyer, it was like a vacant used car dealership. The buyer was able to buy this property with an SBA loan, plus get $600,000 worth of improvement money. So they bought it for $2.9 million. They were able to get another $600,000. The loan amount was essentially about $3.2 million because he had to come in with 10% equity into the total $3.5 million. And he was able to get an even better rate than that because there was real estate involved. But it was a franchise. He's buying a pet care franchise, which is on the company. The franchisor is on the SBA approved list, so it all fit the boxes. If you're going to list and sell property, the reason you need to know this is because someone's going to walk in, the buyer for that vacant car dealership or the vacant bank building or the vacant big box store for you retail guys. Someone's going to come in and go, I would like to turn this into, and it may be a franchise for a dog daycare. And you come to me, and now your problem is that's the only buyers you're attracting, and you're used to saying no, 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 no. If you come to me and I go to Caesar, I go, whoa, guess what? We can plug this in. This vacant QSR that you're trying to sell up in Pensacola can now become X. And we can make that happen for the people who want to make offers on your property. That's why it's important to understand just the basics of what he's talking about today. Right? The last thing you want to say here is, I'll never encounter this because I'm just doing X. I promise you somewhere along the way, it's so good you go, bang, I know how to do this. Car washes, you guys don't do car washes, right?
Well, yeah, we will.
Yeah, so I mean, we've used SBA for car wash financing here at Matthews.
I did one in Broward. It was full construction, ground up construction in Broward on the west side off Pines Boulevard. It's a $3.4 million deal. The property and all of it after appraisal was about $5 million. I just saw the financial statements of that car wash this past month. $1 million in profits that car wash is throwing off. And the man is now planning to build 2 more, one in Orlando and one somewhere else. So again, that one project that we did for this guy here is making him so much money that now he's taking that money and reinvesting it to create more. And you guys can be part of finding him that other property once you've found him this one and you got him the lending. The biggest thing that Brian, maybe you guys don't see this, but he'll be working, he'll be doing, and all of a sudden he'll call, Caesar, I got blah, blah, blah. What do you think? I think I can do that. Okay, good. Like,
Right,
that's
exactly
it.
how the calls go.
That's
I
it.
put it right in the opportunities and go, as soon as someone comes in, I've got this loan in place. So a lot of times if you list a property, I already know if there's an owner user who's going to buy it, I know exactly where to go. So when you list a property and you're going to list a lot of properties and someone says, we'd like to do it, but you know, it kind of fits. I'm not so sure they have the money. You're able to walk into my office and I'm going to make a quick call. And he says, I think so. And I say, give me 4 hours. Sometimes he's slow. Sometimes he calls me the next morning. But I mean, lenders don't call back that fast, right? It takes me days sometimes to get them on the phone. He answers on the second ring. I email it over, and 4 hours later, he's like, we're going to do that deal. So I just sit there and say to you, now you can go back to that buyer's agent, or you can go back to those buyers and put the deal together. And we'll put the financing in place. SBA is so great to have.
Yeah, and I'll share this because I got the blessing from a very excited borrower yesterday saying that I can share this information. I just signed a term sheet. I just signed a commitment letter yesterday for $9.3 million for a partner buyout. My borrower owns 51% of the facility. His silent partner owns 49% of the building. It's a huge facility out in Tampa. You can see it from the highway. Bottom line is the transaction is such that we're lending them $9.3 million. We're covering all the closing costs. Nothing is coming out of pocket. And his partner at closing will get $4.9 million in cash. And my borrower will now own his facility 100%. And once that closes, which should be by June 30th of this month, we're going to start talking about another location he has on the east coast of the
And that
state of
partner's
Florida.
walking away with $5 million in cash,
$4.9 million.
which is going to be taxable unless he does what?
What do you call it? This
1031 exchange.
1031 exchange.
Exchanges it into. So guess what? Now that guy's got to go find a property. Or we would like them to find a property. Maybe they want boring, maybe they don't want any headache, and now they just want to buy a Dollar General. So
So that's another deal. And the amount of fees people are making on a transaction like that are enormous. Okay. You're like really I don't think you guys might not realize it just yet. You all are strategically positioned to be in a place to place you to be able, or position you to be able to make a lot of money. Okay. And just importantly, help a lot of people. Go ahead.
So in that situation where you gave that loan so that the person could buy out his silent partner, in what situation would you say it'd be more beneficial for that person to do, say, like a seller financing? Because I know you were saying to avoid taxes. So it could be like a deferment where he's making interest on the payments over time.
So now there's a few different hats we wear, right? Because I'm an accountant, I understand the value of perhaps creating an installment sale situation, because it's gonna mitigate his tax exposure over the next few years, because it's spread out over each year as opposed to one big lump sum and getting whacked. Okay, I get all that, but typically that type of thing will hopefully be taken care of with the borrower's CPA, CFP before it gets to us.
Okay.
Because at that juncture, you're kind of going over lines that perhaps the organization you're with doesn't want you to comment on, because there could be potential liability for how you're advising people.
Okay.
You follow me?
Yes, sir.
But you're thinking the right way, and perhaps you come up with this idea and you go to your bar. You might want to talk to your CPA about XYZ. See what he says.
Get on a conference call with the CPA,
Right.
all right? I mean, let the CPA direct the transaction and plant the seed in the head, but you're on the right track. Installment loan might be a way to go, but maybe not.
Right.
Okay, so let's talk about that. Give me 1 second. What happens is we look at so many deals every day that I got to make sure that I don't blend them all together.
Right.
So give me 1 second. So I got a customer in Port St. Lucie area. He's buying a pizzeria that's been there for 20 years. The owner is a former Ranger or SEAL, and he's got issues with PTSD, so he just wants to sell everything and just go retire and go to the beach. So my client is coming in. He has a little bit of a sketchy background. He had a rough divorce. Mom is having to co-sign on the loan. They're kind of doing the thing together. They both have hospitality experience in restaurants, so they should be able to run the pizzeria. But we looked at the big picture and we said, we're going to do this loan, but we'll do this loan this way. What was it this way? This way, we wanted, the sellers said that they really believed in our borrowers coming in. So we told the seller, you're going to hold $80,000 in a seller note, and you're not going to get paid on that note until we get paid in full. So it's a 10-year note that we're giving my borrower. So the loan is for approximately $661,000 all in to purchase the pizzeria from the sellers. The seller is holding an $80,000 note on the side. We're going to close. At the end of 10 years, the seller will come back to my borrower and say, okay, you still owe me $80,000. And you know what? If he needs some money, he can come back to us and we'll give him the $80,000 to do that loan. Okay, but that's a situation where, based upon the merits of the deal and the borrowers, from a risk standpoint, we as a lender said, this is what we need to be able to get this done. And we did it.
And you know why the reason they did that is because they said, if he's got 80 grand still on the deal, the seller's still on the hook, it's not going to fail. He's now going to be an unpaid consultant, so to speak, because he wants the deal to work too.
Okay.
He's right on target, because what's going to happen is that we've had the sellers guarantee us that no matter what happens, the first 12 months of this coming year, they will make themselves available to make sure they answer all questions, pizza recipes, the sauce, whatever it is that they do, they will be there to advise them how to get it done. So that's another situation where, again, I'm not sure if you guys picked this up, no commercial real estate involved. They're strictly selling the business, uncollateralized, and we're able to get that deal done. That's not a deal that a bank will be able to get done. Let's keep moving forward. Let's go back to the $9.3 million deal, commercial real estate. That's why you guys are here. That's being done on a program called a 504. okay? 504 is a program where there's a first and a second mortgage. The typical structure of a 504 is a 50, 40, 10. What does that mean? It means that I, as the lender in the first position, will give a loan of 50% of the deal. The CDC, which is the arm of the SBA, they represent the SBA, excuse me, they're going to put in 40% of the loan, and our borrower will put in 10% equity injection. The equity injection can be in the form of actual cash, or it can be in the form of actual existing equity because they could potentially already own the property, like in the partner buyout. Okay. So what happens is the first loan is structured typically on a 5 to 10 year note, fixed for 5 or 10 years. We do them on a 5-year repricing basis. So whatever it is. So if we start the loan at Wall Street Journal plus 0, or let's say Wall Street Journal plus 1, when the 5 years are up, we look at what the Wall Street Journal is that day and add another 1 to that, and that's your new rate for the next 5 years.
Prime, right?
Yes, sir.
Yeah, so they're doing that. They're doing the first loan at prime plus 1. Sounds like expensive money. However,
Now we have the second. The second is done on a very typically, in the good old days, it could be as low as 2.5 to 3%. Today, it's probably more in the zone of 6.25 to maybe 7.25, depending what the circumstances are and what the prevailing pricing is going to be. Let's just say, for the sake of this discussion, it's 6%. So, and that is amortized typically over 30 years, and the first is also amortized typically over 30 years. So what you do is we have what's called a blended rate. Anybody understand what that is? What that would be?
Mix of all the different rates.
a weighted average rate, if you will.
Right. You take the first, you take the second, add them, divide them. That's your blended rate. So typically, instead of telling the borrower, well, your rate is 9.25, it's really not. It's really more like maybe 7, maybe 6 7/8, something along those lines. Because once we factor in the lower second mortgage, it comes down a little bit. So it's more palatable. Okay. So whatever the case may be, that gets closed. It's a first and a second. This type of loan can have a strong prepayment penalty in the way of either on the first, a 5-year declining balance. For example, the deal I'm about to close, that issued the commitment on, has a 5, 4, 3, 2, 1. What's that mean? First year prepay 5% of the outstanding balance. Second year 4%. Third year 3% of the outstanding balance if they prepay the loan. Obviously, we don't want them to prepay the loan, or we put the prepayments in there to protect ourselves, because typically something like that, a bank like us sell it off in the secondary market to make our premiums and just keep and make the next loan.
Do you guys do recourses?
Oh, absolutely.
Yeah.
Absolutely. You know, let's put it this way. Unless one of your clients is a big fish, $50 million net worth, has a serious commercial real estate portfolio, most everyone you talk to is going to have to do what we call a PG, personal guarantee. Okay. What's some of the loans out there? Non-recourse conduit loans. Those types of loans that life insurance companies make, they look at perhaps, let's say this structure here. Something like this is expected to throw off tons of income based upon the lease roll, the rent roll that exists here. Based upon that rent roll and the cash that this building is throwing off, the bankers don't really, or the life insurance companies don't really care about Joe that's buying the building. They care about the building. So his PG really means nothing to them. It's the building that's throwing off the income and has the value that they care about. So in that situation, you might get a loan where it's non-recourse. Okay, but typically, I've never done one. I've been lending for a long time. Every single loan I've done has been a PG. Every single one. So a 504 is something that I would encourage all of you to go online and Google it. Get familiar with it, with the keywords, the what's going on with the first, what's going on with the second. Got any questions? Ask Ryan. You've got my card. Feel free to give me a call. because that's a tool that once you get into the larger dollar amounts of commercial real estate value, you're going to want to know what's going on with, because as the lender, I would rather you do the 7A, because quite frankly, we make more money on a 7A program, but it's all about what's best for the client, what's best to get the deal and get it closed and move forward.
Okay, so before we open up the questions, I want you all to write something down, especially those of you who will be listing and selling properties. As a rule of thumb, owner users pay more than investors. As a rule of thumb, again, not 100%, owner users pay more than investors. If you list a car wash and it goes to an investor, they're going to crunch the numbers, throw the offer out, and say, that's all I'm paying. But if someone walks in with a dream of owning a car wash and building a business and sending their kids to college, and you're on the list side, you're probably going to get more money for your seller. And when you come to me, I'm going to go to Caesar, and we're going to make everybody happy. So let's open it up to questions.
And before we open questions, I want to say two things. I want to say what's on our preferred side of deals we'd rather do, and deals that we're saying non-preferred. What I say is, let's talk about them. I say non-preferred because as far as I'm concerned, every deal has its own characteristic and its own different basis of merit that may overcome a particular lender's opinion of not wanting to get involved in that industry. So the preferred ones, daycare centers. Daycare centers are great, guys, because most of the owners want to own their real estate because it's vital to their daycare center. Okay.
In terms of liability.
No, in terms of
Stability.
yeah,
Okay.
longevity.
Yeah.
Yeah, because if you have a lease and it's not renewed, guess what? You have no business.
Right.
Okay. So daycare centers, same thing. Assisted living facilities, home health care, nail salons, engineering services, CPAs, veterinarians, like he said about pet care, doctors, we love, dentists, we love. I haven't seen one tax return from a dentist that was losing money. Hey guys, we love dentists. Store retailers, wholesalers, furniture and home furnishings, HVAC, plumbing, and manufacturers. Ones that we're going to pause when you bring this up are going to be gyms, business or financial consultants, e-commerce. It was big during the pandemic, but now since people are going back to the malls, we're pausing a little bit and saying, well, what's the deal with your e-commerce? What is it you're doing? Most lenders are not crazy about newer used car dealerships. Okay. It's just one of those things. And then two areas that are tough: custom builders and home improvement. General contractors is typically it's like a 4-letter word. It's not good. We'd rather not do them. Most lenders try to stay away from them, but same time, I've been able to help a lot of them over the years. Okay. And the last one is gas stations and convenience stores. I've done a bunch. So again, if it's a gas station and the bricks, the real estate with the gas station, one lender may look at it and say, we're not crazy about it because if we're gonna get the commercial real estate, we might have environmental issues in the future because of gas spills and oil spills and all that going into the soil water. If they just get the gas station, the convenience store, they might be more excited. We might be more excited because it's just the business, not the real estate. So that's just areas that as far as I'm concerned, I say we pause and listen to it and then see if it has merit. Some other bankers might just say, don't even talk to me about it. Okay. My rule of thumb is let me hear the story because there might be a way to get it done. So that'll open up. Any questions?
So especially in like a tighter lending environment like we're in now, what are like the key return or debt coverage metrics that you're looking to see on a commercial real estate loan?
That's a great question. Just to repeat it, so if you're hearing it out loud, Levi asked, what did you ask again? What are the metrics? What are the debt service coverage you're looking
Debt
for?
service or
Yeah.
return metrics?
That's a great question.
In the industry, that 1.20, 1.25 is your general rule of thumb. On the SBA side, we can go as low as 1.15, and I've seen exceptions made to 1.0. Again, depending on the merits of the deal. Okay,
How many years would you be comfortable with a 1.0?
that's a great question. All right, so typically we want to see the last year definitely cash flow, and better than 1.20 is great. Okay, if the prior years are not quite there, especially with something like the pandemic that just hit, it's understandable that 20 or 21 might be soft. Okay, but typically speaking, we definitely want to see the last tax year cash flow, and the stronger the prior years can be, it just helps the deal that much better. And current interim financials also help us get a picture as to what the current trends are and what's going on with the business. Okay,
Makes sense. Thank you.
anybody else?
On the 504, who did you say provides the first 50%?
The bank.
The bank?
Caesar,
Me.
pay first.
So I'm planning on focusing on industrial properties, and one of the trends we've been talking about with our mentors is that owner users have continued to be very active in this market because they have essential businesses and they have working capital. So for an owner user that say has collateral to get a loan from a conventional bank, what would be some of the other benefits of using SBA versus conventional when the collateral isn't an issue and let's say deposit size is an issue?
Oh, that's a good question.
I'm gonna answer that. So
Go ahead.
if they have money and they have equity, they're gonna get better terms on a non-owner occupied, just conventional real estate loan.
Right.
But you've got two offers. You've got two people coming in. One has a bunch of money, so you think that's the easiest thing, but they're only willing to pay $3.5 million for the property.
Mhm.
The other guy who needs that property and is willing to stretch, and I can get him a 90% loan, is willing to pay $4 million. Now you're able to present both of those offers to your seller.
Okay.
And this is important because a lot of people won't do this. You guys want to give your sellers, if you've listed the property, more options. You want to show them everything out there. They may decide, the sellers might say, I'd rather take the investor that's going to pay less because it's a cleaner and easier deal. But they might say, you know what, I want the extra $500,000, so I'd rather talk to the owner user. Now, if you've got an offer from another firm, a client from another firm, and two identical offers, and one of them is an owner user, you want to talk to me, and I'm going to talk to Caesar and see, is this a viable deal? And by the way, we'd like to source the debt too. But then all of a sudden you've got an even happier seller because you've presented a higher option for them. You made them more money. What's $500,000 mean to an investor? Well, it means that two of his grandchildren get to go to college for free. Like, they don't have to borrow money or do anything. Those kids get to go to college because that grandfather got an extra $500,000 because you were smart enough to say, I remember when they talked about SBA for owner user. Let me see if I can get that one guy up a little bit. Did that answer the question?
Absolutely.
Okay, great.
Thank you.
And he's bringing up two good points too. Owner occupied, owner user / investor.
Mhm.
SBA does not like investors. We can't lend to investors. So if we have a commercial piece of real estate, they have to occupy at least 51% of the total square footage to be eligible for a 504 or 7A loan. Okay?
Yeah, so I want to point something out. They only have to occupy 51%.
Right.
Because I look at that and go, my gosh, someone can buy a facility and still rent the back bays or whatever, as long as it's less than 49% of the square footage.
That's right.
Yeah, that's a big thing.
What was your question?
I'm sorry, I asked if you could just repeat what you had said.
Oh, of
prior.
course. Sure. So to be 7A or 504 eligible to include the commercial real estate, they must occupy at least 51% of this total square footage. One thing I want to stress to you guys is try not to get yourself into a situation where you're thinking yes or no. This can happen, this can't happen. Try to put yourself in a situation where, you know what, I think there's a deal here. And if you don't know what to do with that deal, reach out to your mentors. because they've done so many different things in these years that in structuring and just putting things together in such a way that you would sit back and say, holy smokes, I would have never thought about it. That's right, you wouldn't have. That's why, you have these mentors. That's why we've been around for a while to be able to do these things. There's just things out there that you can do. You just don't know until you do them. And you know what? I'm still learning every day. Believe it or not, I've been doing this for over 20 years. Okay? Any other questions?
You mentioned that some loans can be anywhere from like 80 to 100% loan to value. Like,
Mhm.
what makes you comfortable with a 100% LTV deal?
Dr. Jones.
They love doctors. SBA love doctors. So who's going to do medical office? Yeah. I mean, you list an office and Dr. Jones wants to put his clinic in there and it's going to take 60% of the square footage. Dr. Jones gets to buy that thing for lower no down payments, no equity in the deal, and he gets to lease it out to all the other doctors and dentists in the town. And your seller gets a higher price for the office building, which allows that seller to fund the second and third generation streams.
And to be more realistic, it's just not Dr. Jones. It could be a very strong borrower with a tremendous balance sheet, with a very strong personal financial statement, a business that's thrown off cash that's just doing so well that we look at it and say, hey, Mr. Smith, we're going to do that for 100% financing because you're so strong. You can afford it. Then we don't have a problem with the risk. So it's if it's a strong borrower, we have every motivation in the world to work with a borrower that's strong because it's a good risk and we're going to make money.
Any other questions, guys?
Right here.
Oh, sorry.
So SBA loans would be good for self-storage units as well.
Yeah.
A lot of those are owner.
We can, one of my buddies just did, at the last bank he was at, he did an $18 million one on a 504 program. So you bring up a good point. So there's 7A, 504, and I forgot one more, USDA.
Oh, yeah.
If you put in the zip code into the USDA site, it'll tell you immediately whether it's USDA eligible. If it's USDA eligible, it's kind of like a 7A program and a 504 program based upon the dollar amounts and the way that we price it. But that gives you another option out there to be able to do things that, again, a traditional bank may not be comfortable doing because, again, on the USDA, there's government guarantees of different levels and from 70 to 85 to maybe I think even 90%. So there's every reason to want to do that type of loan.
Was that $18 million deal local?
No, I believe it was in Georgia.
Oh, okay.
It was in Georgia.
Sure. Question. It's about the mom and pop selling their business to their son.
Yeah.
I learned about succession in my family business class, so I learned about all the different, techniques, and I kind of don't understand. I think I do understand why would they want to sell it to their son? Why won't they just like put it into a trust or?
Well,
is it because they wanted to get the 1.2 in cold hard cash to retire?
that's an inducement.
And then the other one was they love their son.
Yeah.
Damn.
Couldn't they just
Right.
transfer ownership, or
Then how do they get the money?
Then how do they get the money?
so that they just won't get the one?
They don't love them that much.
Okay.
Yeah.
They love them enough
Yeah.
to want $1 million.
Yeah.
Okay. I understand. They want to profit and give it.
Right.
What do you want to walk away with some?
Okay.
They were millionaires before that closing, but that day they were liquid millionaires. It's a
All right, guys,
difference.
listen, I'm going to cut you. I'm going to let you stick around, but I'm going to stop the broadcast. How about a round of applause for Caesar? Yeah. He's going to stick around for a little bit so you can ask him